Most traders come to the market believing in lines. They draw them clean, straight, confident. Support below, resistance above. And they tell themselves the market will respect those lines because it has before. And I always ask, quietly, who told you the market owes you that respect? You see, a man can make money using support and resistance, but not in the way most men think. The failure is not in the lines themselves. The failure is in the belief that the lines are the reason price turns. That's where the trouble begins. A level is not power. It is only memory, and memory in the market is a dangerous thing to trust blindly. Now let me ask you something. When price returns to a level, what do you believe is happening there? Do you imagine some invisible force holding price in place? Or do you understand that what you're really seeing is unfinished business, orders left behind traders, trapped intentions not yet fulfilled? Because if you don't understand that, then every line you draw becomes a guess dressed up as certainty. Most traders mark support because price once went up from there. Simple enough. But they never ask the important question. Why did it go up? Was it strong buying? Was it short covering? Was it a temporary imbalance? And more importantly, is that same force still there now? You see, when a trader ignores that question, he assumes repetition. And when a man trades on assumption, the market has already begun to take his money. Support fails because the reason it held before is no longer present. It's as simple and as unforgiving as that. Now consider this. A level that has been tested once may hold, tested twice perhaps still. But each time price returns, something changes. Orders are filled, positions are closed, interest fades. And I'll ask you, how many times can a door be knocked on before it finally opens? That is the part most traders never grasp. They think repeated touches strengthen a level. In truth, repeated touches often weaken it. Because what held price before is being consumed piece by piece. So when the level finally breaks, they are surprised. But they shouldn't be. The market was telling them all along. Now let's go a step further. Have you ever noticed how clean support breaks tend to happen when everyone sees the level? When the chart looks obvious, when it feels too clear, that's not coincidence. That's participation. Because when too many traders place their confidence and their stops at the same place, they create liquidity. And liquidity is what drives price. So when price breaks that level, it is not failure. It is fulfillment. The market is not disrespecting your support. It is using it. Let me put it plainly. When a trader buys at support with a tight stop just below, he is not just risking money. He is providing fuel. And when that stop gets triggered, what follows? Selling pressure, acceleration, momentum, cause and effect. Always, that's the language of the market. Now ask yourself, are you trading the level, or are you trading the behavior around the level? Because there's a difference, and it's the difference between guessing and understanding. A skilled trader doesn't simply mark support and wait. He watches how price approaches it. Is it slow? Is it aggressive? Are the candles shrinking or expanding? Is volume increasing or fading? Because when price rushes into a level with strength, what follows is often continuation, not reversal. And yet, how many traders buy simply because price has arrived at support? Too many. And they wonder why it fails them. You see, the market does not reward location alone. It rewards context. Without context, a level is just a line. And a line has never made a man wealthy. Now let me give you something practical. Something you can use the next time you sit in front of a chart. When price approaches a level, don't ask, will it hold? That's the wrong question. Ask instead, what is price doing as it gets there? If the move is strong, fast, and confident, then you must consider the possibility of a break. If the move is hesitant, corrective, and weak, then perhaps the level has a chance. But even then, you wait for confirmation. You wait for behavior. You wait for the market to show its hand. Because anticipation without evidence is nothing more than hope. And hope, in this business, is expensive. Now think about this. How often have you seen a level break only for price to reverse afterward? A false breakout, they call it, and traders get confused. They say, support failed, and then it worked again. But that's not confusion. That's misunderstanding. Because the level didn't fail or succeed. The order flow changed. First, stops were triggered. Then, liquidity was absorbed. Then, new participants stepped in. It's a sequence. And if you don't understand the sequence, you'll misread the outcome every time. So the real lesson here isn't that support and resistance don't work. It's that they don't work the way most people believe. They are not barriers. They are battlegrounds. And on a battleground, the outcome is never decided by the line in the sand, but by the strength and intention of those fighting around it. Now tell me, when you draw your levels, are you thinking about the traders trapped above, the stops resting below, the institutions waiting for liquidity? Or are you simply drawing lines and expecting obedience? Because the market doesn't obey. It responds. And when a trader finally understands that something shifts, he stops predicting. He starts observing. He stops reacting to lines and starts reading behavior. And that is where consistency begins to form. Not from the level, but from the understanding behind it. Because when you know why a level holds, you also begin to see when it won't. And when you see that, you stop being surprised by failure. You start anticipating it, and that changes everything. Most men believe a level fails because the market suddenly becomes unpredictable. That is not so. A level fails for a very simple reason. The force that once held it is no longer there. Now let me ask you something. When price first turned from a level, what caused it? Was it the line itself? Or was it the presence of strong buying or selling at that point? It was never the line. It was the imbalance. You see, when price moves sharply away from a level, it leaves behind evidence. Buyers overwhelmed sellers, or sellers overwhelmed buyers. That moment creates what traders later call support or resistance. But what they fail to understand is this. The move was caused by orders, not by the level itself. And orders, unlike lines, do not last forever. When price returns to that same area, most traders assume the same buyers or sellers are still waiting. They place their trades with confidence, thinking history will repeat itself. But they rarely stop to ask, are those participants still active, or have they already finished their business? Because when that original buying or selling has been exhausted, the level becomes hollow. It may look the same on the chart. It may sit at the same price. But the force behind it has vanished. And when a trader acts on appearance instead of reality, he puts himself at the mercy of the market. Now consider what happens over time. A level is created, price moves away, and then the market drifts back. Along the way, positions are opened, closed, adjusted. Traders who bought early take profits. Institutions distribute or accumulate elsewhere. The landscape changes. So when price returns, it is not the same market anymore. Yet the trader treats it as if nothing has changed. That is where the mistake is made. Because when a trader buys at support assuming strength, and that strength is no longer present, what follows? Price does not hold, it slips. And as it slips, doubt begins. Then stops are triggered. Then selling increases. Cause and effect, always. What looked like a strong level becomes a point of acceleration. Now here is something a thoughtful trader learns to watch. How price behaves when it returns. Not just where it is, but how it moves. If price approaches slowly, with hesitation, you may suspect that opposing pressure still exists. But if it drives into the level with speed and conviction, what does that tell you? It tells you the market is not respecting the level. It is pressing through it. And that only happens when the opposing side is weak or absent. So instead of asking, is this support? You begin asking, is there still a reason for this support to exist? That question changes everything. Because now you are not trading a line. You are evaluating a condition. And conditions change. A level that once held perfectly can fail completely. Not because the market is chaotic, but because the underlying cause has shifted. The buyers who defended that price are gone. The sellers who once hesitated are now confident, and the trader who fails to see that shift finds himself trapped in a losing position, wondering why something that worked before no longer works now. But the market has already given the answer. It always does. A man sees a level hold once, and he gains a little confidence. He sees it hold twice, and now he begins to believe in it. By the third touch, he is no longer observing. He is convinced. But let me ask you, does repetition always mean strength, Or can it also mean exhaustion? You see, most traders are taught that the more a level is tested, the stronger it becomes. It sounds reasonable. After all, if price keeps rejecting a level, surely that level must be important. But the market does not operate on appearances. It operates on supply and demand. And every time price returns to a level, something is being used up. Think about that carefully. When price first hits resistance and falls, it is because sellers were strong enough to overcome buyers. That is the first reaction. But when price comes back again, those same sellers must defend the level once more. They sell again. Orders are filled again. Now I'll ask you, how many times can a man spend the same dollar? Because those sell orders are not infinite. Each test consumes liquidity. Each reaction reduces what remains. And while the chart may show a clean line, the reality beneath it is changing with every touch. So by the time price approaches the level for the third or fourth time, the situation is no longer the same. The visible level is unchanged, but the strength behind it has been quietly drained. And yet, this is the moment when most traders feel the most confident. They say, "It has held before, it will hold again." But what they are really doing is trusting the past without accounting for what has been lost along the way. Now consider what happens when price finally breaks through. Traders are surprised. They call it a false level, or they say the market is unpredictable. But there is nothing unpredictable about it. The level did exactly what it could until it could do no more. It was not strong. It was simply not yet exhausted. There is a difference. Now let's bring this into something you can actually use. When you see a level being tested repeatedly, don't grow more confident. Grow more cautious. Watch how price behaves on each return. Are the reactions becoming smaller? Are the rejections weaker? Is price spending more time at the level instead of moving away quickly? Because when a level is truly strong, price does not linger there. It reacts sharply. It moves away with purpose. But when that strength begins to fade, price starts to press against the level. It hovers. It leans. It tests. That is not strength. That is pressure building. And pressure in the market rarely builds without consequence. Now think about the traders involved. Each time price touches the level, new traders step in, placing their trades based on what they believe is a reliable area. They add to the position. They place their stops just beyond the level. So what happens when the level finally gives way? All those positions are forced out at once. Stops are triggered. Momentum increases. What began as a slow weakening becomes a sharp move. And again, cause and effect. The repeated tests did not strengthen the level. They prepared it for failure. Now I'll ask you, when you see a level being respected over and over, are you seeing strength, or are you watching something slowly being worn down? There is something a trader learns. If he stays in the game long enough, the market has a way of punishing what looks obvious. Now let me ask you, when you look at a chart and a level stands out so clearly that almost anyone could see it, what do you think that really means? Do you believe you've discovered something valuable, or have you simply joined a crowd? Because in this business, clarity often attracts company. And company, more often than not, changes the outcome. You see, when a level becomes obvious, it draws attention. Retail traders, professionals, algorithms, they all begin to focus on the same price. And with that focus comes action. Orders begin to cluster. Entries form around the level. Stops gather just beyond it. And that is where the real story begins. Because the market does not move for your analysis. It moves for liquidity. Now think carefully. What is liquidity? It is simply the ability for large players to enter or exit positions without disrupting price too much. And where does that liquidity come from? It comes from other traders' orders. So when a level becomes crowded, it becomes valuable, not as support or resistance, but as a pool of orders waiting to be used. Let me put it plainly. When traders buy at support and place their stops just below, they are not just protecting themselves. They are placing sell orders beneath the level, and when enough of those stops accumulate, they form a target. Now I'll ask you, if you needed to sell a large position, where would you prefer to do it? In an empty market, or where there is a concentration of buyers and stop orders? The answer is always the same. So what happens next is not random. Price approaches the level. Traders step in as expected, and for a moment it looks like the level is holding. Confidence builds. More traders join. The crowd grows. And then, when the time is right, price moves through the level. Stops are triggered. Those sell orders flood the market. Momentum increases. What looked like a safe entry becomes a rapid loss. And the trader, who believed he was trading a strong level, realizes too late that he was part of the liquidity. Now understand this. There is nothing wrong with identifying obvious levels. In fact, they are often the most important areas on the chart. But their importance is not in their ability to hold. It is in their ability to attract participation. And participation changes everything. So instead of asking, is this a strong support or resistance? You begin to ask, who else is watching this level and what are they likely to do? Because when you understand what the crowd is doing, you begin to see what the market might do to the crowd. Now here is something practical you can carry with you. When a level looks too clean, too perfect, too obvious, pause. Do not rush in simply because price has arrived. Watch how price behaves around it. Does it reject sharply or does it hover and press? Because when price lingers near an obvious level, it often means the market is preparing, not respecting. And preparation in this business usually leads to movement. Also pay attention to what happens just beyond the level. Quick spikes, sudden breaks, fast reversals. These are not accidents. They are signs of liquidity being taken. The move through the level is not always the true move. Sometimes it is the mechanism. So the lesson is not to avoid obvious levels. It is to understand their real function. They are not lines of defense. They are magnets for orders. And when a trader mistakes a magnet for a barrier, he places himself exactly where the market needs him to be. A trader believes his stop loss is protection. He places it carefully, just beyond a level, thinking he has defined his risk and secured his position. But let me ask you, what if that very stop is part of the reason price moves against you? You see, most men think of their stop as something personal, something private. But in the market, nothing is private. Every stop is simply an order waiting to be triggered. And when enough of those orders gather in the same place, they stop being protection. They become opportunity. Now consider how most traders are taught. Buy at support. Place your stop just below. Sell at resistance. Place your stop just above. It sounds logical. It feels safe. But what happens when thousands of traders are doing the exact same thing? Their stops begin to cluster. And when stops cluster, they form liquidity. Now I'll ask you, what happens when a stop loss is triggered? If you are long, your stop becomes a sell order. If you are short, your stop becomes a buy order. That means stops are not just exits, they are fuel. So when price reaches a level filled with stop losses, it doesn't just break the level, it accelerates. Because each triggered stop adds to the momentum. One order triggers another, then another, and what you get is a chain reaction. Cause and effect. Always. What looked like a controlled move suddenly becomes fast and aggressive. Traders panic. Positions unwind. And the move extends further than most expect. Now here is where the misunderstanding lies. The trader thinks, the level failed, so my stop was hit. But the truth is often the reverse. Your stop, and thousands like it, help create the move that hit it. Now think about that for a moment. When price dips just below support, and then snaps back up, what has happened? Stops were triggered, liquidity was collected, and then price moved in the opposite direction. And when price breaks cleanly and continues, what has happened there? Stops fueled continuation. Momentum was built on forced exits. In both cases, the stops played a role. So instead of seeing stop losses as simple protection, you must begin to see them as part of the market's structure. They are predictable. They are visible in behavior. And they are often targeted. Now I'll ask you, when you place your stop, are you placing it where it makes sense to you or where it makes sense to the market? Because those are not the same thing. If your stop sits exactly where everyone else places theirs, then you are not hidden. You are exposed. You are part of the crowd. And the crowd, more often than not, provides the liquidity for the move. This does not mean you should avoid using stops. That would be foolish. Risk must always be defined. but it does mean you should think more carefully about placement. A thoughtful trader does not ask, "Where is the nearest level?" He asks, "Where are others likely placing their stops? And what happens if those stops are triggered?" Because when you understand that, you begin to see the market differently. You start to recognize why price often moves just beyond a level before reversing. You begin to expect acceleration once a clean break occurs. You stop being surprised by sudden spikes and sharp moves. They are not random. They are reactions to liquidity being released. Now bring this into your decision making. When price approaches a level, consider not just the level itself, but what lies beyond it. If a break would trigger a large number of stops, then you must be prepared for speed. Either you wait for confirmation after the move, or you step aside entirely. Because entering blindly at the level, without considering the stops around it, places you directly in harm's way. And the market has a way of finding those who are positioned carelessly. It does not need to hunt you. It simply follows the path of liquidity. A trader sees price approaching a level and immediately begins to think in terms of reversal. Support means buy. Resistance means sell. It is a habit, almost automatic. But let me ask you, does the market slow down before it turns? Or does it speed up? Because if you watch closely, you'll notice something most traders ignore. The manner in which price approaches a level often tells you more than the level itself. Now consider this. When price moves slowly, with pauses, small candles and hesitation, what does that suggest? It suggests uncertainty. It suggests that neither side is in full control. In such conditions, a level has a chance to hold because there is no strong force pushing through it. But what happens when price moves fast? Wide candles, little to no pullback, a steady, aggressive push in one direction. That is not uncertainty. That is conviction. And I'll ask you, when conviction meets a level, what do you expect to happen? You see, strong moves are not random bursts of activity. They are the result of imbalance, one side dominating the other, buyers overwhelming sellers, or sellers overwhelming buyers. And when that kind of pressure builds, it does not simply disappear because price reaches a line on your chart. Pressure seeks continuation. Now think about the trader who sees resistance ahead and decides to sell, even as price is charging upward with strength. He believes the level will hold because it has before. But what he fails to see is that the current move is not the same as the previous one. The market is telling a different story, and when a trader ignores the story and trades the level blindly, he places himself against momentum. Now what follows when you trade against a strong move? At first, nothing dramatic. Price may pause. It may even pull back slightly. The trader feels reassured, but then the pressure resumes. The move continues, and soon his position begins to suffer. If he holds, his stop is eventually reached. If he exits early, he exits in doubt. Either way, the outcome is the same, because he traded the level, not the behavior. Now here is something you must learn to recognize. When price approaches a level with strength, it is often not testing the level. It is challenging it. It is probing for weakness. It is searching for liquidity beyond it. And more often than not, that kind of approach leads to a break. Not always, but often enough to matter. So instead of asking, "Is this resistance?" you begin to ask, "What kind of move is driving into this resistance?" Because that question shifts your focus from location to momentum, and momentum is what carries price forward. Now let's make this practical. When you see price moving aggressively toward a level, resist the urge to step in front of it. Do not assume a reversal simply because price has reached a familiar area. Instead, observe. Let the market show you whether it is slowing down or continuing with force. If the candles remain strong, if pullbacks are shallow, if price barely hesitates at the level, then you must consider continuation as the more likely outcome. And if you choose to act, you act with that understanding, not against it. This may mean waiting for a breakout and then looking for confirmation. It may mean avoiding the trade altogether. But it certainly does not mean blindly fading strength, because fading strength is one of the quickest ways to lose money in this business. Now consider the opposite. When price approaches a level and begins to slow, when candles shrink, when movement becomes uneven, That is when the level becomes meaningful. That is when a reaction has a foundation. So the key is not the level itself, but the energy behind the move. Strong energy breaks, weak energy hesitates. And when you begin to see that clearly, you stop treating all approaches the same. You start to distinguish between pressure and exhaustion. And that distinction is what separates reaction from continuation. Now ask yourself, when you look at a chart, are you seeing levels, or are you seeing the force that drives price into them? There is a certain kind of movement that most traders overlook, not because it is hidden, but because it appears unremarkable. Price drifts. It moves in small steps. It pauses often. There is no urgency, no force, no clear dominance, and the average trader pays little attention to it. But let me ask you, when the market approaches a level without conviction, what does that suggest? It suggests weakness. Now understand this clearly. Weakness in movement is not always a sign of reversal, but it often creates the conditions for one, because when price lacks strength, it lacks the ability to push through opposition, and a level, under those conditions, has a greater chance of holding. You see, when price moves towards support or resistance in a hesitant manner, small candles, overlapping structure, frequent pauses, it tells you that neither side is fully committed. Buyers are not eager. Sellers are not aggressive. It is a market without urgency. Now I'll ask you, what happens when a market without urgency meets a level where reactions have occurred before? There is a higher chance that participants will step in again, not because the level is magical, but because the lack of pressure allows it to function. This is where most traders get it wrong. They treat all approaches to a level the same. They see price arrive and immediately act, without considering how it arrived. But the path matters just as much as the destination. A slow approach is not just slower in speed. It is different in meaning. Now consider what often happens during these weak approaches. Price will grind toward a level, forming minor pullbacks, showing hesitation. Traders watching closely may notice that each push becomes slightly less effective, that momentum is not building. That is information. It tells you that the market is not preparing to break through. It is simply drifting into the area. And drifting markets are more likely to react than explode. Now let's bring this into your decision making. When you see price approaching a level in this slow, uncertain way, do not rush. Observe the structure. Look for signs of continued hesitation. Look for rejection, small failures, wicks inability to push further. Because when a level holds, it often begins quietly. Not with a sharp reversal, but with a subtle shift. Now I'll ask you, have you ever seen price reach resistance, stall, and then slowly begin to turn? No dramatic move, no sudden collapse, just a gradual change in direction. That is often how weak approaches resolve. The level does not need to fight hard. It simply absorbs what little pressure exists, and once that pressure is absorbed, the market begins to rotate. Now compare this to a strong approach. There, the level is tested with force. Here, it is approached with uncertainty. The difference is not in the level, it is in the behavior, and behavior is what you must learn to read. But there is another layer to this. Weak approaches often trap impatient traders. They see price nearing a level and expect immediate action. When it doesn't come, they force entries. They anticipate a breakout that lacks the energy to occur, and when the breakout fails, they are caught on the wrong side. Cause and effect. A lack of strength leads to failed continuation. Failed continuation leads to reversal. So instead of asking, is this level going to break? You begin asking, does the market have the strength required to break it? Because without strength, there is no break, only hesitation. And hesitation, more often than not, gives the level room to hold. Now think carefully, when you next watch price approach a level, will you focus on the line, or will you study the way price moves toward it? Because in that movement, quiet as it may seem, the answer is already forming.